Hey everyone, it's Kuru here with another daily property update coming to you from the beautiful Bankstown Golf Course, September the 7th, Sunday. Happy Father's Day to all the dads. Guys, by the way, make sure to hit the like button and subscribe so you can get your daily property update every single day from me so that you can have all the information you need to be a property insider. Now, guys, I want to chat about vacancy rates at the moment because the vacancy rates have been very, very low now for about 5 years, and we would have thought that they should be improving, but because of the constraints to bring new property to the market, they are not. Now, the most recent data shows that across the combined capital cities, the vacancy rate is just 1.2%. Now, most economists, most property experts do agree that 3% is a balanced market. And in my experience over the last 15 years, working very closely with a real data scientist and a real actuary, Liana Pan, Australia's #1 property researcher, we have always found that when you invest into a market with above 3.5% vacancy rate, the capital growth and also the rental growth tends to be a lot lower and the risk of vacancy begins to become high. So yes, 1.5%. And our experience is extremely low. Now, there is nothing on the horizon that will change this because we need to be building 240,000 properties every single year completed to really dig our way out of this. And as you can see on this chart, we've never hit 240,000. I've spoken about this quite a lot. Now, here's the chart to look at the capital cities. As you can see, Adelaide, Brisbane, and Perth are having the biggest problems right now. Sydney and Melbourne, not as bad, but also very, very low. But you will see, for example, in Melbourne, this will actually get worse before it gets better because Melbourne has become so affordable now. I'll put this chart up here. You can see Melbourne now is actually the most affordable capital city in the country. That means less people will leave Melbourne because a lot of people were leaving Melbourne to go to Perth, to go to Adelaide, to go to Brisbane, to go to the Gold Coast. A lot of it was affordability reasons and also just what's happening in the state, taxes and all different types of things. But a big part of it was just housing affordability. Now, because these other markets have actually become more unaffordable than Melbourne, we will see a slowdown of interstate migration of Aussies leaving Melbourne to go elsewhere. So when you compound the fact that the majority of the overseas immigration comes to Sydney and Melbourne and less people leaving Melbourne, you will see the vacancy rates in Melbourne get worse before they get better. Now, what you want to do if you're an investor right now is you do want to target micro markets, suburbs that have a vacancy rate 1.5% and below. Make sure you get in there. And also, because the vacancy rates are so low, it means that renters now are starting to do the math and the calculations of, hey, should I become a buyer? Now, one of the big things that holds renters back from becoming a buyer is that you can normally rent for 2 or 3% of the cost of the property. And to own the property, you've got to pay 5, 6, 7% of the cost of the property every single year in terms of a holding cost or an owning cost. But a lot of renters now, because they want stability and because they want security and certainty of where they're living, are starting to redo the math. And of course, with interest rates coming down, 3 cuts in the last 6 months, possibly 1 or 2 more cuts coming even this year, beginning of next year. So we are going to see a huge price war in the affordable end of the market. You know, properties below 1.2 million, below 1 million, 800K, depending on the capital city, investors and first-time buyers will be attacking this market, especially when you add on top of the fact that the government's 5% deposit scheme begins 1st of October. If you're a renter now and you're looking at getting in the market, get in now. Try to find something now. If you cannot afford to buy a property in the area that you live now, continue to rent, but become a rent investor. And I'll put a link below to my video on rent vesting so you can figure out what that means. But basically, rent where you are, but get on the property ladder. Get a property somewhere else within your budget. If you're renting right now, try to extend your lease. You know, if you're coming up to the end of a 12-month lease, maybe be proactive and go to your landlords, go to your property manager. Try to extend that lease by another 12 or even 24 months if you can and lock those prices in, because there's no way out of where we are right now in terms of this housing crisis and the low vacancy rate. Guys, make sure you hit the like and subscribe button if you want more information like this. Get all the latest stats, data, guidance, and advice from me about the property market and the economy so you can be a property insider to take care of you and your family. Make sure to follow this channel. Take care, everyone. Happy Father's Day.